For just 9 rupees and 80 paise, the simple price of a small cup of tea, you can become an owner of India's 100 fastest growing small cap companies. All at once, in a single click, and for just 12 rupees, you can invest in India's top 750 companies. This covers 100 large cap, 150 mid cap, 250 small cap, plus the remaining micro cap stocks. And that too, for just 12 rupees. Can you imagine this? And this is not a scam or clickbait. It's a 100% legal and practical approach. These particular SEBI highly regulated ETFs are openly traded on the NSE and BSE exchanges. Anyone can buy them, but 90% of retail investors don't even know about them. People are still making losses today by randomly selecting stocks. People invest 2000 rupees in penny stocks and forget about it, and then they wait for them to become multi-baggers. Based on my research, 9 out of every 10 penny stocks end up going to zero. 1 or 2 penny stocks become multi-baggers, and that too only if you are very lucky. Meaning, if you were to select 10 penny stocks and invested exactly 2000 rupees in each of them, then your total investment would be 20,000 rupees. Now, if you were to wait for 10 years, and let's assume, as per the data, that 9 out of 10 penny stocks go to zero, and only 1 becomes a multi-bagger, the 5 rupee penny stock you bought becomes 50 rupees. That means almost 10x growth. Even then, you still lose money, because out of 20,000, 18,000 were lost, which were invested in the 9 penny stocks, and the 2,000 you invested in one stock became 20,000. This means that even after 10 years, you are right where you started. On top of that, the inflation over 10 years, and the annual maintenance cost of your demat account would have been paid out of your own pocket. If that 5 rupee stock had become 100 rupees, meaning it grew 20 times, you would still be at a loss, because 18,000 of your 20,000 would be lost in 9 penny stocks, and that 2,000 invested would have become 40,000. Meaning in 10 years, your 20,000 investment returns a total of 40,000, which is a return of only 7.18% CAGR. It would have been better to invest your 20,000 rupees instead in 10 different set of ETFs instead. If you get an average CAGR of about 15%, then after 10 years, your corpus would be around 80,911 rupees. After 20 years, it would become 3,27,331 rupees. And after 30 years, 13,24,235 rupees. If you really want to grow your money effectively, then simply make a smart decision today and get serious about your financial future. You should stop investing your hard-earned money in random penny stocks and choose to invest in ETFs of fundamentally strong companies instead. As per NSE data, in India, there are over 250 ETFs listed on exchanges. And it is true that many of these ETFs are trading for less than 20 rupees. By investing in these ETFs, you can now invest in India's top companies and use that to build a very strong portfolio. Just think about how significant the effect of compounding will be 20 years from now. You might lose money in penny stocks, but here you can create wealth effectively in the long term. And today, I am going to tell you about the top 10 such ETFs that are trading for less than 20 rupees each. But please remember, they are not this cheap because they are bad or low quality ETFs. They are cheap because they have been launched recently. And each ETF will give you a different investment opportunity. Watch this video to the end to discover exactly why this is where your total wealth can potentially multiply. Let us begin. First, we have the Angel One Nifty Total Market ETF. This particular 12 rupee ETF invests your money in India's 750 companies, and that too, the top level ones. It includes 100 large cap, 150 mid cap, 250 small cap, plus the remaining micro cap stocks. All of this combined covers India's entire listed stock market, covering almost 95% of the total market cap. This signifies that your investment will be distributed across 95% of the whole of the Indian stock market. You really cannot get more diversification than this. At only 12 rupees. I also made a very detailed video explaining how this ETF actually works, its growth potential, and all its future returns. People really liked that video. It actually gained more than 2 lakh views and well over 10,000 likes. And I have also conveniently put the direct link to that video in the description for you. Do check it out. Now, let's move to number 2. And at number 2, we have the Grow BSE Power ETF, which is trading at just 9 rupees and 80 paise. This ETF specifically focuses directly on the Indian power sector. It invests in power generation companies, power transmission companies, and also power distribution companies, thereby covering the complete power value chain. The current scenario in the power sector looks very exciting. India's power demand has been growing at CAGR of 7% over the last 5 years, and the government's official target is to achieve 500 gigawatts of renewable energy capacity by 2030. This means a massive capital investment is going to happen in this sector. Solar plants, wind farms, transmission infrastructure, smart grids, money will flow everywhere, and its direct or indirect benefit is destined for the BSE Power Index since that collection features many of India's prominent leading companies like NTPC, Power Grid Corporation, Tata Power, Adani Power, Adani Green, JSW Energy, etc. etc. Looking at 5-year data, the BSE Power Index has delivered returns of about 213%, which is almost double the return of the Nifty 50. But the risk here is also a bit high. This is because the power sector is heavily impacted by government policies. Coal prices, regulatory tariffs, and environmental norms, these factors directly affect the profitability of power companies. Therefore, this ETF is for those investors who have a genuine conviction in thematic investing and are seeking to gain exposure to the broader story of India's energy transition. There is risk, but if you look at the long term, the potential is also huge. Moving on, we have the Mirae Asset Nifty 500 Multicap 50-25-25 ETF. This ETF follows a different, disciplined approach to investing, which includes growth, balance, and stability. This ETF invests 50% of its money in large cap companies to maintain stability in the portfolio. It invests 25% in mid caps, so it can capture growth, and the remaining 25% in small caps. This strategy is followed basically to get extra returns on the portfolio. In other words, this strategy allows them to follow an overall balanced approach. The investment is not just in a single cap. The price for one unit of this ETF is currently around 16 rupees. Its AUM is around 52 crore and the expense ratio is only 0.16%. In fact, this ETF is perfect for investors who want complete market exposure, but definitely do not want to be over-concentrated in just a single market segment. Next is the Zerodha Nifty Small Cap 100 ETF. It's India's lowest price small cap ETF as of today. It is currently trading at just 9 rupees, 80 paise per unit. This ETF precisely replicates the Nifty Small Cap 100 index. And guess what? In the last 5 years, this index has delivered CAGR of 26.1%, whereas the Nifty 50 has given a return of only 17.7%. That means an extra return of almost 9%, and I have taken this data from the official NSE website. Although I know that past returns are not a guarantee of the future, yet we recognize that the highest growth in the market and volatility is found in the small cap index. Here, the risk is a bit high, and so are the returns. So, for investors who want to beat the market and generate alpha by taking high risks, then this is a truly perfect option for them. According to a money control study, the average portfolio of those doing consistent SIP in small cap ETFs since 2015 has grown 3.8x, which is almost 4 times. This implies that someone who invested 10 lakh rupees now has 38 lakh rupees, but this journey was actually extremely volatile throughout. Portfolios fell 25% in 2018, plus the COVID crash in 2020, which caused a 40% drop. But those who remained invested and who actually continued their SIP created the absolute maximum wealth. The investment strategy is simple. Allocate a maximum of 20 to 25% of your entire portfolio to small cap ETFs and hold for a minimum of 10 years. This is the most powerful category for long-term wealth creation. Next is the Grow Nifty 500 Momentum 50 ETF. It's one of the best active investment strategies. Academic research clearly indicates that stocks which have performed very well in the last 6 to 12 months demonstrate a very high probability of performing quite well within the next 6 to 12 months as well. This is called the momentum effect. The Nifty 500 Momentum 50 Index does exactly this. It automatically selects the top 50 stocks from the Nifty 500 universe based on their 6-month and 12-month price momentum, essentially the fastest upward trending stocks get added automatically. Rebalancing happens every 6 months. Slow moving stocks are removed and then fresh momentum stocks are added. Looking at the backtested data, the Nifty 500 Momentum 50 Index has provided a CAGR return of 30.30% over 5 years. The Nifty 50 gave only 17.7%. That means a return that is slightly less than double. Now, you decide. Would you still want to invest in the Nifty 50 Index today? Or would you prefer to take a little risk and benefit from momentum? Personally, I would go with the latter. The decision is in your hands. Again, this data has been taken from the official NSE website. This Grow ETF launched quite recently. Its track record is limited, but the performance of the underlying index is solid. But remember one thing, momentum strategies can indeed underperform a bit during periods of high volatility. There can also be rapid reversals. That's why such ETFs are suitable only for aggressive investors. Next is the Tata Gold ETF. The performance of this ETF has broken all records. It has given a 69% return in just the last year. I still remember last year during Diwali when I made a reel on this, its price was just 7 rupees. Today it is 13 rupees. That's slightly less than double. In the past year, when the equity market was flat, gold really showed its true shine and has given outstanding returns to investors. And this is not paper gold. This ETF holds 99.5% pure physical gold, stored in vaults. This is the real, actual physical gold. Don't hesitate before investing. According to data from the World Gold Council, portfolios with a 10 to 15% gold allocation demonstrate significantly superior risk-adjusted returns when compared to those of typical equity market investors. By the way, there is another way to trade and invest in gold. Gold petal futures. Here, you can trade in 1 gram gold futures with just 1000 rupees. Here, you can make high profits along with high risk. I have also produced a detailed video on this subject, explaining how you can generate a profit of up to 1200 rupees by trading in gold petal futures with a margin of just 900 rupees. The link is in the description. Be sure to check it after the video ends. By the way, while we are talking about gold, how can we possibly forget about silver? So next is the Zerodha Silver ETF. The performance of this ETF broke gold's records. This ETF was launched in March 2025 with an NAV of rupees 10. And today, as I am making this video, its price has already crossed 21 rupees. That's a 108% return in just 8 months. But hold on, there is actually another similar silver ETF, Tata Silver ETF, whose price is also around 20 rupees. This ETF started in January 2024 when its NAV was 7 rupees. And today it's around 20 rupees. In the last 1 year, this ETF has given a return of 135%. And the biggest reason for this is the momentum in silver prices. Over the last year, silver prices have jumped nearly 150%, which, as you would expect, has a direct impact on the price of silver ETFs. Now, hear this interesting news. The author of the book Rich Dad, Poor Dad, Mr. Robert Kiyosaki, predicts that the price of silver can go up to 7.5 lakh rupees per kg. This clearly means there could be another 250% growth from here. Well, I truly cannot say for certain if the price of silver will actually climb to such a high level in the future, but day by day, the use cases and demand for silver are increasing very rapidly. Silver's high electrical conductivity makes it an extremely important material for solar panels, electric vehicles, semiconductors, and electronic devices today, as global reliance on green energy and tech continues to grow. The overall global demand for silver has reached truly record high levels, which makes this white metal both a future-ready investment and a vital industrial metal. This could be the right opportunity for a long-term investment. Now let us talk about some global ETFs through which you can invest outside of India. US, China, Japan, and other countries, and basically use that to strongly diversify your portfolio. The first one is the Motilal Oswal Nasdaq 100 ETF, which invests in top US tech companies like NVIDIA, Apple, Microsoft, Google, Netflix, Amazon, Alphabet, Tesla, etc. In the last 5 years, this ETF has given a return of 156%. Just think about it. How big the business of these US tech giants is. While the entire Indian stock market has a market cap of around $4 trillion. NVIDIA alone has a market cap of $4.37 trillion. Can you imagine that? Similarly, Apple's market cap is 4.12 trillion, Microsoft's is 3.62 trillion, and Google or Alphabet is $3.80 trillion. NVIDIA's market cap alone is equal to 22 Reliance companies, with single shares priced between $200 and $250 or 20 to 30,000 rupees. And yet, there actually exists a simple way to become a shareholder in these global giants with just 100 rupees, without investing thousands or lakhs of rupees, and without opening a US bank account directly from your mobile app. I have covered the details in this video. I explain the step-by-step process that with just 100 rupees you can invest in shares of the biggest US companies, demonstrating exactly how you can acquire the top 10 global AI stocks and, in the coming times, will also help you take advantage of the growth in the AI sector. And what's more, how you can also benefit from rupee depreciation by investing in US dollars. Because when you choose to invest in US stocks, you are effectively investing in those strong dollar-denominated assets. This means your money gets converted into dollars, and yields are also in dollars. Historical data from the last decade shows the rupee depreciates by 3 to 4% against the dollar each year, and you get a direct benefit from that. Every year, your returns increase by an extra 3 to 4% if US stocks have given returns of 18% per annum, and the rupee has depreciated by 4%, resulting in a total return of approximately 22% per annum. So be sure to watch this video. I have put the link in the description. Next ETF in our list is the Mirae Assets NYSE FANG Plus ETF that tracks the NYSE FANG Plus index, consisting of just 10 major mega cap US stocks like Apple, Amazon, Meta, Alphabet, NVIDIA, Microsoft, Netflix, Tesla, Alibaba, and Baidu. One very special feature of this index is that it is equally weighted. This means every company gets almost equal weight. This reduces the over-dominance of a single stock, ensuring you receive a balanced exposure to the top global tech leaders. While the entire Indian market is currently consolidating, this specific ETF has delivered a strong positive return of 25% in the last year. And in 5 years, it has given a return of 234%. Now, if you want such high return ETFs regularly, there is a separate section in the Angel One app, where you can easily find all the high return ETFs in one place. Look here, you will find multiple categories of ETFs. Options like index ETFs, gold ETFs, silver, and global ETFs. If you want low cost ETFs, they are also available. Here, you will also find all of the various ETFs that are trading below 100 rupees. Select the one you like, check its performance thoroughly, and if it seems right, you can invest directly from there quite easily. Honestly, this app is amazing. I have put the link in the description. Do check it out. By the way, there is another ETF that invests in global US giants in a similar way and tracks the collective performance of the Standard & Poor's 500, that is to say, the top 500 leading US companies, where you can invest with just 100 rupees and even start an SIP for the long term if you want. The complete details of that particular ETF and the step-by-step process on how to invest are both covered in this video. So, be sure to check it out. I have put the link in the description. And yes, don't forget to subscribe to the channel for more such interesting videos. Jai Hind.